What is going on, guys? Today we are going to be talking about assignment in options trading. Now, I know we've been talking about this a lot recently, but I really want to make a video specifically about assignment because it was honestly the scariest thing for me, and I feel like for other people when they're getting into options trading, because all they see, because when you see assignment, it means that you have to buy or sell 100 shares that you don't have unless you're selling covered calls and puts. But that's really scary to a lot of people because when you're buying 100 shares of, say, like Apple here, you're going to have to spend over $30,000 in order to get those 100 shares, and vice versa. If you have to sell them, that's $30,000 you don't have. But that's why I want to talk a little bit more about assignment and what you can do to cover yourself so you don't accidentally go bankrupt. On Robinhood, it automatically covers you. It doesn't let you just sell calls and puts unless you have like a spread or you already have the 100 shares or the cash available to buy the 100 shares. So you're good on Robinhood, but on other brokers, they'll just let you sell whatever you want. They'll let you literally do whatever you want. They don't really cover you, so you just got to be really careful on other brokers. So let's get more into what assignment is. Let's go down to a contract that I got assigned on. So let's check out this HD call options contract that I got assigned on. It was a 225 call, and it went in the money because HD went up to 231.91 by expiration. So I got assigned on this contract, and it's a call, so that means I had to sell the 100 shares, but I actually bought two of the contracts. That's why it says 200 right here. So I had to sell this 200 shares for a $45,000 credit, which I received. I got this $45,000 on assignment because when you're selling a contract, you're receiving the credit into your account. So even on a put assignment, you would still get this credit into your account because you're buying an options contract. You're not actually buying and selling the shares. I mean, you are in a way, but if you don't have the money or don't have the 100 shares to fulfill the contract, then they're just going to credit your account because you sold the contracts to someone. So even if you don't have the 100, 200 shares, they're just going to sell this contract, and you're going to have $45,000 in credit. And this credit is technically not mine because I didn't have 100 shares or even 200 shares of Home Depot. So this credit I received has to go somewhere, in which I would have, if I didn't have this cover down here, which we'll talk a little bit about, but that's going to be for a completely different video. I may have this $45,000 in credit, but I sold 200 shares that I don't have, so I'm negative 200 shares of Home Depot. So somehow, some way, I have to buy these shares back. If I didn't have this cover down here, I'd have to buy the Home Depot stocks at $231.91. Let's do the math on that. So if I had to buy these at $231.91, that would be $46,382 because I bought two of these options contracts. So I'm down 200 shares. It's not just one contract, which is it kind of sucks because I wish I only had one contract because I feel like it would be easier to explain. But just understand that I'm doing two contracts. So if anything doesn't make sense, just divide anything I'm doing by two, and you'll be at one contract. So divide this by two. That'd be 23,191 per 100 shares. So I would have to buy these back at 23,191 for 100 shares. Well, 200, so the 46,000. Luckily, this was a credit spread. It wasn't just selling a naked HD call. So I have this cover down here which says that I can buy Home Depot stocks at 227.5. So that cost $45,500, and that closes out this credit, and it closes out the negative 200 shares I have because I bought 200 shares, but it costed me $500. But as you can see on a credit spread, I received $204 on this contract, and I received $200 on this contract. So this actually only cost me $96. It didn't cost me $45,000 to close out this assignment. It just cost me $96 because I already received credit down here. And if you don't know anything about credit spreads, just go watch all our other videos. We have a bunch of videos on credit spreads and explaining assignment and exercising, so we got you covered. But let's say this was a put, for example. Say this was an HD 225 call put, and Home Depot was down at 220, let's say, instead of selling the 200 shares, we would have to buy the 200 shares at 225 because the contract went in the money if Home Depot was below 225. And this is for if it was a put. So don't get confused. I'm just trying to explain the inverse of this. So if it was a put and Home Depot was trading at 220, this would be in the money. So if you had a 222.5 put contract that you bought, you could exercise that, and then you would, just like this contract, you would only lose the $96 or whatever, assuming you collected the same credit, but it would just be backwards. So let's go into an options chain, and I'll try to explain it for the people that don't understand. But I hope you're kind of understanding what assignment means and how it affects contracts. And there's so many different strategies to like selling contracts: covered calls, covered puts. You could sell naked on other brokers, which is really risky, like I've said, because you don't know where this stock's going to go. You might end up having to pay like over $1,000 even though you received $45,000 in credit. So let's go to AMD and check out this options chain and try to explain what would happen in assignment. And it's around $50, so it should be pretty easy to explain. So on a call, say we had this 50.5 and it expired last week rather than the 24th, just assume, and this expired in the money, we could potentially get assigned on this contract right here. And the options contract states that we have to sell 100 shares to someone at $50.50, even though the stock's trading at $50.83. In this case, you would probably actually make money, but since the stock's trading at $50.83, we would lose about 30 cents per contract, so that would be about $30. So in this case, you would make money because you collected a credit of 117, but if it went farther, say to like 52, you'd be paying over $1 a contract, so this would be irrelevant. You'd lose your money quick. But that's why you do spreads, so you could buy this 51, and even though it didn't go past 51, if it did, you would be covered and you wouldn't have to spend more than the collateral, which on this would be $23. So that's not too bad. $27 for 23. If this went down, if this went to $50, that's a pretty good credit spread right there. So same thing on the put side. If we sold this 51 contract, this would be in the money. We would have to buy the contract at 51, but we probably don't have the $5,000 to buy 100 shares of AMD, so we would have to sell them at 50.83 and lose whatever. But just like the other contract, we might make money because we receive more credit in that case. But if it went to like 49, we'd have to sell the shares all the way down here at like 49 or wherever it was at. And then our credit would be irrelevant. I mean, we wouldn't lose as much money, but that's when we would start losing money, is if it went like down to even like 45. We might have to pay over $1,000 because we don't have the collateral for that. That's why you sell spreads. So you buy this 50.5 contract. If it goes down to 50, you're able to buy the shares back at 50.5. So if it goes below 50.5, you're able to sell the shares you got back at 51 for a $50 loss, but you only lost $50 rather than if it went down here and you weren't covered, you'd have to pay, a few hundred, maybe even 1,000 or so. So don't get too confused on that. All assignment really is someone just fulfilling the contract that you're selling. If you're selling this contract, you have an obligation to buy the contracts at this price, or on a call, you have the obligation to sell it at that price. And you just can never forget that. When you're the seller, you have to fulfill the contract. But when you're the buyer, you get to choose if you want to fulfill the contract or not, or just sell the options contract. You have a lot more decisions when you're a buyer than if you're a seller. But statistically, more option contracts expire worthless than they do go in the money. So selling contracts is actually way more profitable in the long run, so long as you use the right strategy and don't do anything stupid. I can't really phrase that any other way, because you just got to be really smart when you're selling premium. There's a lot that can go wrong, especially if you're not covering yourself. And even if you cover yourself, if your credit to collateral isn't that great, then you could screw yourself in the long run if you lose multiple plays. So I just want you guys to be careful when you're selling contracts, because yeah, it is statistically a lot more profitable, but you still got to be careful. There's a lot of variations in the stock market and in options trading, so just be safe out there. Paper trading is probably the best thing you can do if you are up to the challenge. But I hope you guys enjoyed this video, and just remember, if you get assigned on Robinhood, you don't owe them $45,000. That would actually be insane. Just know that this will get cleared. You can email your broker if you just want to have peace of mind and know that it's getting cleared, but they're going to clear this because you would never owe Robinhood this much money off of $50, $100 play. You'd have to do something a lot more crazy. So just do your research. Assignment's really not a big deal so long as you're doing spreads, you're not selling naked contracts, or you have the 100 shares. If you're not comfortable with doing spreads and you're still scared of assignment even after this video, be sure to paper trade, because once you paper trade and you see what happens, I've gotten assigned on paper trading contracts. Literally nothing happens, so it's not even a big deal. As long as you have the covered contract, or you have the 100 shares, you have the cash available, you will be fine. So I hope you guys enjoyed this video. If you have any questions, leave them in the comments below. Leave a like on the video, subscribe to the channel. We post daily. We're live Monday through Friday, market open to market close, and I'll see you guys in the next video.